Hi everyone, welcome back to another video. So today's video I'm going to be going over what is, in my opinion, probably one of the most important factors I've learned myself as a trader. There's nothing really that can compare to this because, I mean, technical analysis and strategies, they work obviously, but if you can't comprehend your trading psychology, you are going to go nowhere. So quite obviously today's video is trading psychology, which, like I said, is in my opinion the most important factor. Now before I jump into it, I'm just going to lay out a little fact for you, which is actually quite worrying. So the fact is that 74 to 89% of retail traders actually lose their money within the first 3 to 4 months. That's not 3 to 4 months, sorry, it's 2 to 3 months of trading. So they lose their money within 2 to 3 months of trading. Sorry, I'm quite slow when I write, but you'll get the gist. Also, I'm not too sure how long this video will be. If it is quite a lengthy one, I do recommend maybe getting a notepad and pen, or just jotting down like a couple of notes on your iPhone or your iPad, or if you're one of those kind of people, Samsung, whatever kind of device you have, just jot down some notes just so you can keep up. Also, as always, if you have any questions, you can always feel free to message me, you know you can. So 74 to 89% of retail traders lose their money within the first 2 to 3 months of trading, and this is mainly because of the psychological aspect of trading, or trading emotionally. Now, what is a retail trader? A retail trader is me or you. A retail trader is someone with a few £100 or a few grand or whatever. They open up a trading account and they start trading Forex. That is a retail trader. So Forex is mainly made up of obviously all the banks and the high members of the government that kind of influence all the market's movement. So retail traders, we're described as rats, and the reason why we're described as rats is because we like to pick up the crumbs. And what I mean by this is, like, when the market's moving huge amounts, we jump on board, ride the momentum, and we pick up the crumbs. Hence the term, we're called rats. It's not a brilliant term, but that's what we're called, unfortunately. So let's lay this as an example, shall we? Let's get rid of this quickly. Bear with me. So let's say we've got Larry. Well, let's just say Harry because it's my name. Let's just say we got Harry here. Now Harry is, let's say Harry can be a boy, a girl, a cat, a dog. It's 2019, you know, he can be whatever you want to be. I'm not discriminating you. He could be bi, gay, straight, whatever you want him to be. So Harry here, he opened up a trading account, and Harry put £300 in his trading account. And within the first month, let's say he did really well and he made £300 profit, essentially doubling what he used to deposit. So with that £300 deposit, he's now made an extra £300, bringing his total. So that's 300 equals 600. Doesn't take a genius to figure that out. So he now has £600 in his trading account. And during this time, in the first month, he was trading. So first month of trading, my arms aren't long enough. Ugh. So first month of trading, he was trading at 1.0.10, sorry about that. So he was trading at 0.10, get it in your fucking head, H. 0.10, which is £1 per pip. £1 per pip. And let's say first month, £300 profit, that's 300 pips profit, trading at £1 per pip. And let's say Harry isn't too happy with the growth of his account. He wants to be making more money, and he wants to be seeing more frequent big numbers come into his trading account. So what does he do? He doubles his lot size. Why not? He can afford to. So he doubles his lot size to 0.20, got it first time then, which is £2 per pip. I'm just going to see if you can actually see me go lower, just in case the camera is pretty shy. You can just about see it. Sweet. So, second month of trading, he's trading at £2 per pip. let's say, for example, Harry didn't see many losses. He never saw a very big loss, or he never saw very frequent losses in his first month. So he's very happy and he's very confident to double his lot size. Let's say on the first trade, he puts his lot size on and he gives it a stop loss of about 30 pips. And let's say this trade hits stop loss. So with that, it'll be £2, obviously times 30, which is £60. So he's just lost £60, which is why it hit stop loss. So he's now going to be thinking, shit, excuse my language, I've just lost 60 quid. Where obviously it took him a month to build 300 and he's just lost 60 in one trade. Psychologically, what he's going to be thinking now is, oh crap, I need to be making back the money I've just lost, and I need to put a big enough lot size on so I can make back the money I've lost plus more profit. So what does he do? He doesn't stick with his lot size, he doesn't go back to the original, he doesn't do that, which would have been the best thing to do, or even call it a day and maybe reassess the markets. Pardon me. Where he's now emotionally disturbed, let's say, because he's so pissed off that he's just lost £60, he will essentially double the lot size he's just used. Let me just get rid of this. So Harry will now essentially double the lot size he has just used. So instead of using £2 per pip, he is now using 0.40, which is, you guessed it, £4 per pip. And where Harry before, in the first month, where he was trading at 0.10, the biggest loss he could have possibly taken from a 30 pip stop loss was £30. That would have been the biggest loss he would have been able to have with a 30 pip stop loss using £1 per pip. Now where obviously he's quadrupled his lot size by the second month because he's so annoyed that he's just lost 60 quid and he wants to make back the loss as well as make a profit, he is now trading at 0.40. Now, with trading at a lot size like this, a lot of people do not tend to look at the pips, they tend to look at the cash. So when you start seeing trades go in and out of profit, that's when people start to worry, because obviously the markets obviously go like this. They go up, down, up, down, up, down, up, down, up, down. You know, like, picture it as Nicki Minaj twerking. The bum's going up and down, up and down. So markets will always go up and down. Therefore, when you're in a trade, you're going to be frequently going into a profit, into a loss, into a profit, into a loss, into a loss, into a profit, so on and so forth. Now, because he's not used to this lot size, he's not used to seeing the kind of numbers that appear when using this lot size when in a particular pip loss. So let's say he's at minus 10 pips for the trade. Just from those minus 10 pips, he's already at minus £40. Now, to Harry, this is a significant number. He's not used to seeing any more than 30 pip loss if it hits stop loss. And already it's at 10 pips, no way near his stop loss, and it's already minus 40. What does he do? He may be thinking, do you know what, I'll let this run, I'll see where it goes. Let's say it now goes into a 20 pip loss. Now, you guys have probably seen it before where sometimes my trades can go into 5 pips profit, 10 pips profit, and then go into a 15 pip loss, and then I hold it, and then it'll go back into profit again. That's completely normal. I mean, don't think that that's a really bad thing to do. It's completely normal. So anyway, he's now at a 20 pip loss on this trade, adding up to £80 loss. Where, obviously, like I said, he's not used to seeing these kind of figures. He's going to be thinking, shit, I'm going to have to close this trade before I lose even more money. So let's say he went in for, I don't know, he went in for a sell. He went in for a sell, for example. So he went in for a sell there. He went into a little bit of profit, but he wasn't that happy because he needed to make back the original £60 that he just lost. So he went in for a sell, and by the time he went in for a sell, wasn't too happy with the profit. The market started going up and up and up. And what does he do? He decides that £80 is far too big. I'm going to close that because I don't want to lose any money. He'll close it right there. 9 times out of 10, it's Sod's law, basically. 9 times out of 10, when this happens, you close it at that because you're scared of this number. But really, you look at this. You should be looking at your pips, not the money that you're losing or the money that you're making. You should be looking at the pips you're making or losing. That is what determines you as a good trader or a bad trader. So he will now close this trade at £80 loss. So he's already lost 60 quid. We just get rid of this bit here. So he's already lost 60 quid. And now he's lost another 80. So you could do 60 plus 80, which is 120. So he's already at a £120 loss. And where he decided to close his trade at its peak, when let's say his stop loss was up here, if you're not going to let a trade run to its stop loss, don't fucking do the trade. Otherwise, what's the point? There's no point closing it at a 10 pip loss or a 4, 5, 10, 6, whatever pip loss if there's no point putting a stop loss on, if that makes any sense. So what I mean is, don't put a stop loss on and then close it way before your stop loss because you're scared of the figure. Like I said, look at the pips, not the money. Not the figure, look at the pips. So he decides to close his trade up here. And what happens? Sod's law takes over his life. He has a mental breakdown and the markets start coming down ever so slowly, coming closer to his original entry price. And this is when, psychologically, you could probably think I'm exaggerating, but I've seen this so many times before with beginner traders. He will go in the trade again using the same lot size because he's thinking, I need to make back 120 quid. So he'll go in for a sell here. It'll go into a small bit of profit and then it'll go right back up again, which could be news inflation or it could be market consolidation. It could be anything that makes the market go that way. Now, obviously, this isn't exactly what might happen. He might even see a bit of luck and he might have closed it, but I'm just using this as an exaggeration to, pardon me, bloody hell, make the fact of trading psychology more important. Bloody hell. So let's say he now went back into that trade and then it went up to a 30 pip stop loss and he decided I'm just going to let this run. So he let it run and then he got a 30 pip stop loss, which was another £120 loss. So all in all, in that one day, he's just lost 240 quid. Now, a lot of people tend to, when they see these kind of figures at a loss, they tend to throw trading away. They don't tend to want to give it another go. But the thing is with trading is that you are going to see losses. No matter how good you are as a trader, no matter how good your psychology is, no matter what, you will see losses. Warren Buffett sees losses, I see losses. If you're a trader that says you've never seen a loss, you're talking shit. Excuse my French, or Spanish, whatever. Get rid of my name. So a lot of people then tend to withdraw and just not bother. But what I'm going to do is kind of show you a way, what I do psychologically, which is much beneficial for me because this is how I've been trading for the past 2 years. So what I usually do is I set 3 take profits. So I got TP1, I have TP2, and I have TP3. Now, 9 times out of 10, I usually set my TP1 to 20. Brilliant. I usually set my TP1 to 20 to 25 pips. I usually set my TP2 at 30 to 35. And I usually set my TP3 to 40 to 60, depending on what kind of news I'm expecting on the trade or how the trade's been moving so far today, etc, etc. But that's not the point of the video. So the reason why I do this is because these are good pips to bank. They genuinely are. The whole point of Forex is about banking small pips consistently over a long period of time. If you're one of these traders that likes to hold their trade just because you want to make big bucks on one trade, in my opinion, it's silly, it's stupid, it's futile. I mean, I personally wouldn't do that. I used to do it in the past and I've done a few things on that before, but that's where I started making mistakes, and this is where I changed up my strategy. This is why I do what I do now. So usually what I do, you've probably seen me sometimes, when the trade's in 10 to 15 pips profit, let's say I've got 3 trades running, so let's say it's in 10 pips profit times 3, you've already banked 30 pips. Because sometimes I close my trade at 10 pips, that's absolutely fine. Don't, like I said, do not look at the figure that it is showing you as your profit in money. Look at the profits in pips. I've done a video on my Instagram, which is labelled Can Forex Make You Rich? And I pretty much went into it as if you're trading at 0.1 for the first month, 0.2 for the second month, 0.3 for the third month, so on and so forth, and I can show you how much money you made, would have made over a long period of time if you're consistent. But a lot of people don't do that. A lot of people get too greedy, they're too impatient, or they just want massive things to happen over a short period of time, because a lot of people get into Forex and think that it's some sort of get rich quick scheme, or it's something they can make a lot of money really quickly. Theoretically, yeah, you can, but doing that is what will cause you a lot of mistakes, and like I've learned in the past, it genuinely does. So even then, closing at 10 pips profit, like I said, that's fine. You know, you can have 10 pips today, you could have 6 pips profit tomorrow, you could have 7 pips profit the next day, you could have 40 pips profit the day after. You know, it varies. I mean, 9 times out of 10, or sorry, 10 times out of 10, it does depend where the markets go, which depends on, you know, how much profit you're going to be making, etc, etc. So let's put an example on the board. I'm just going to pause the video there, just so I can get a glass of water because my throat is dry as fuck. Like I said in the before video, I don't know whether you're finding this interesting, but if you are, happy days. If you're not, get a box of tissues and cry about it. But yeah, I'm going to go get a glass of water, and then in the second video we'll go on to part 2, and I'll give you a few more what's the fucking word? I can't get my fucking words out, but you know what I mean. I'm going to give like a part 1 and a part 2, sorry about that. Yeah, so yeah, go get yourself a cup of tea or take in what I've just told you, and then we'll continue in the next video.